Hi, everyone, and also hi to Freddie and Renato, who are going to be the speakers tonight. I'm just going to be the moderator for their conversation. So thank you, Freddie and Ren, for joining tonight. And thank you, Ren, actually, for joining from New York, where it's very early in the morning. So thanks for that. We have quite a significant group of people. So it looks like the topic is of interest to quite a few people. We are going to talk about thematic investments, and maybe before I leave a couple of minutes for Freddie and Ren to introduce themselves, and then for Ren to actually give us a little bit of background about ARK. Let me make a couple of steps back. So this webinar tonight, this conversation is jointly organized by StashAway and ARK Invest. You might ask yourself why StashAway decided to do a webinar on thematic investments, and the reason is that we have launched 3 sets of thematic portfolios a few weeks ago across all of our markets, except Thailand, where we haven't launched yet. So if you are in Singapore, in Malaysia, in Hong Kong, or in the UAE, you will have access to our new portfolios. Just log into the app and you'll find them. The 3 portfolios are: one gives exposure to what we call tech enablers. So technologies such as cloud computing or blockchain. You can think about them as kind of a back-end technologies, artificial intelligence, things like this. The second thematic group of portfolios gives exposure to the future of consumer tech. So it's fintech, it's gaming, it's e-commerce, is in general the future of mobility. So you can think about it as more of a front-end technology that you actually get to use. And the third group of portfolios that have exposure to a theme have exposure to healthcare disruption or healthcare innovation. Things like biotechnology or genomics, and things that go into the direction of hopefully the development of what healthcare will look like in quite some time. Now, in each of these portfolios, which are built with our usual StashAway logic of creating balanced portfolios across different level of risks, and maybe Freddie will talk about it later, in each of these portfolios, you'll find a variety of different ETFs in order to get exposure to the specific themes and to the balancing assets. And some of these ETFs are managed by ARK Invest, who's probably the most famous, I guess, thematic focused investor in the world, which is why we decided to work together with Ren and create this session for tonight. And we can go in more details later. Now, before I hand it over to Freddie and Ren, a couple of things. So first of all, quick introduction on Ren. He's the client portfolio manager at ARK Invest. As I mentioned, he's actually joining us from New York. I'll let him introduce himself in a second. And then the other panelist is Freddie. If you have been familiar with StashAway, you probably saw his face before. Is obviously one of the 3 co-founders of the company together with me and Nino, and he is also our chief investment officer. So he's, if you have any questions on why we build a thematic portfolio in a certain way, he's the right person to ask these questions to. On this point, if you have any questions, there is a Q&A function on the app we are using, Zoom. Please use that Q&A function to write any question. The way we're going to do it tonight is we're going to have a conversation with Ren and Freddie. I'm going to ask them a few questions, and we're going to just talk about this topic. And at the end, we'll leave ample space for your questions. I'll try to go through them and try to put them in an order that makes sense, but I'll try to address as many as we can given the limited amount of time. We also have a couple of colleagues from StashAway in the background that will try to answer some of the more StashAway specific questions in writing, because obviously I'm not going to go through kind of some of the more basic stuff. So if you have any questions on StashAway, feel free to write them there as well. One of our colleagues will also address them. Okay, so I guess enough background information. Why don't I leave you to Freddie and Ren to introduce yourself? Maybe Freddie, why don't you start so that Ren then can talk about ARK more extensively?
Yes, thank you, Michele, for the intro, and also for the participants for taking the time to come and join us. Now, I'm one of the 3 co-founders, as Michele has mentioned, and I personally have a 20-year journey in the industry of fund management. So that's how old I am now, and hopefully that translates into more wisdom I'm personally excited about our teams and also a series of teams that's to come from tomorrow. So stay tuned, and I would like to give the opportunity for Ren to introduce himself.
Yes, thank you, Freddie. I am the client portfolio manager. I've been with ARK since 2018. I came from kind of the traditional wealth management world where I conducted investment research and due diligence, and noticed that there was definitely a void in investors' portfolios as I was building these portfolios for high net worth and institutional clients that I had. They didn't have any exposure to innovation. And so I came across ARK back in 2015, shortly after they had launched, and found something that solved the problem I was looking to solve. And so the rest is kind of history. But just to kind of take you back into kind of what ARK does, right? So in terms of our philosophy, process, and team, I think it's very unique from any other kind of traditional asset manager out there. Cathie Wood, our founder, CEO, and CIO of the firm, founded the firm back in 2014, really for two main reasons. One, to be a firm that focuses solely on disruptive innovation in the public equity markets. That's where we see the most opportunity from a market inefficiency perspective. Investors that have been investing in the public equity space have been very benchmark oriented, right? And can be very backward looking, right? So we're looking into the future, what the world will look like, 5 years, maybe 10 years from today, looking how big these technologies could be and how they'll impact all of our lives, and then investing in those key kind of enablers and beneficiaries that we think will grow, over the long term. In order to kind of identify these inefficiencies, you really have to be structured in a way that's not your typical kind of Wall Street firm, right? We had Cathie completely changed kind of the investment process. And one of the second reasons that Cathie started the firm was to create new dimensions in the research process. And so what we've done, which is unlike any other firm out there, has completely open sourced our research ecosystem, where we're pushing out all of our research out there as it's happening, right? And also educating individuals. So you are free to kind of go to ark-invest.com, click on our research center, and you'll have access to all of this research free of charge, right? This is first principles research, right? We're not taking research from other sources. We're conducting this all in-house and sharing it with the world, but also getting very valuable feedback from those that are maybe building these technologies, maybe professors that are following some of these technologies, and even some venture capital investors that are looking at them at a very early stage. So we invite them onto our ecosystem to collaborate and really share ideas. And I think that's what's very unique about kind of how Wall Street has been traditionally kind of closed off that mentality. Everyone's conducting their research. They don't do much sharing, but you could be, when we're forecasting 5-10 years out, we could be making a potentially mistake in one of our assumptions. And if you drag that out over a multi-year period, you could be making an exponential mistake when it comes to determining exponential growth opportunities, right? And so what our analysts have done, and I think one very unique aspect of our analyst team is that we hire these analysts that have domain expertise in the technologies that we're researching, right? And that's because we think technology is really seeping into every industry and sector of the economy, right? So if you don't have comfort around the technology and how that's going to impact your sector or industry coverage, that could put you at potential risk, right? At constructing a portfolio, because we've identified several industries and sectors that are becoming more vulnerable to disruption, right? And a lot of investors have exposure to them. And so this whole kind of thematic approach is about identifying the trends of the future and investing on a forward-looking basis, right? Past asset allocation and strategies have been based on kind of backward-looking, right? What has succeeded in the past is certainly, it's not indicative of what will succeed in the future. And so that's what we're trying to solve, and that's what we're trying to provide with kind of our innovation-focused strategies. The other thing I'll mention, right, and how we kind of look at the world and look at how big these opportunities could be, we've broken them down into what we call 5 innovation platforms. So we have artificial intelligence, we have energy storage, and maybe just to go back, artificial intelligence really focused around deep learning, which is taking the human element out of the equation when it comes to developing software. Right. So no longer will we have to deploy, thousands of human resources and programmers to solve a problem. These computers, through deep learning algorithms, are actually solving them on their own, right, through unstructured data and massive amounts of data that we're feeding. And that's the key. And that's the advantage for many of these companies, is having access to that underlying data. That we think is a massive opportunity in and of itself, and will affect all industries, right? You go back to the most recent innovation platform that has evolved that we all use, and that's the internet, and that's impacted most industries. We think artificial intelligence will actually impact every single industry and sector. The second is energy storage. That's really the shift away from gas powered vehicles to electric vehicles. So away from fossil fuels and onto the grid. The next is robotics, more specifically adaptive robotics or collaborative robots. These are not your typical industrial robots that are in kind of the auto manufacturing space, right? These are robots that are actually working alongside humans, doing some of the tedious tasks that humans, may be doing, picking items and putting them in boxes for shipping, which Amazon has now increased their number of robots on their warehouse floors. Right. This, we think, is going to create automation processes. This will lower the cost of goods, make them more affordable to the masses, right? And sure, there will be displacement of jobs, but there will be new industries and new growth potential that will benefit. So we see it as a net positive, right? The short-term impact is maybe potentially job loss, but education will be very important, and automation will make our lives much better. The fourth is genomics. Or DNA sequencing. This is really the foundational technology that has gotten us out of this pandemic, really, where we've been able to sequence, the coronavirus in a matter of days. We've been able to, using that technology, come up with a vaccine within 41 days. And now, we've tested it since then and rolled it out, right? So that technology is actually gaining significant traction, and we think is really about kind of unlocking the code to life, right? And so if we can understand our genomes and understand that very quickly by running them through these DNA sequencing technologies, we can actually, detect diseases earlier, have a better plan on prevention, and then treating them in a more targeted area. So this will reinvent, the healthcare industry. AI is actually, there's a convergence right now that's underway, and that is going to create bigger and more exciting opportunities as well. And then finally, blockchain technology, and where we've been very focused on in the last 6 years, almost since our founding, was been on Bitcoin, and we still are very focused on Bitcoin, really around kind of this decentralized nature, taking the friction out of kind of the financial services industry. There's a lot of friction today. When you're looking at store of value, we see Bitcoin as a kind of neo gold, right? And so this is cross-border. It's reducing transaction cost across borders, and creating a very large opportunity. And Bitcoin, as a first mover advantage, we think will be the winner in this space. Now, a newer kind of area that we've been more focused on and been able to invest in has been in the decentralized finance space. So think Ethereum as kind of an example of that space, and all the apps that are or dApps, I should say, being built on top of that ecosystem. So that's becoming more and more attractive to us, and something that has become more investable in, say, the last 12 months. So combined, before I turn it back, combine these 5 innovation platforms, we think will create, we were saying at the beginning of this year, $75 trillion worth of business value and wealth creation. We've just revised some of our forecast, and we think this could be in excess of $100 trillion. And when you think about the global equity market today, that stands at roughly about 100 trillion. So this is just new value created over the next 10 years as a direct result of these 5 innovation platforms. And I think one of the biggest things I see out there as I talk to clients, from retail clients all the way up to big pension plans and sovereign wealth funds, is they don't have enough exposure to these very big opportunities in their portfolios. And so that's what we're really trying to provide. What we've seen is, pre-pandemic, the value was around 7 trillion. That's doubled to now 14 trillion, and now potentially going to 100 plus trillion by 2030. And so we've seen kind of this acceleration in growth and adoption for these technologies as a direct result of the pandemic, right? This has accelerated the adoption. These technologies are solving problems that many of us have been faced with, businesses and consumers, right? And so we believe that these 5 innovation platforms are investable now, and there's no return, there's no going back to normal, right? They've gained this traction, and they will continue to accelerate in adoption. And so that's presenting, us with very attractive investment opportunities across those 5 platforms.
Thanks a lot, Ren. You got me at $100 trillion of new value created. I started kind of buying the thematics portfolio of StashAway. No, jokes aside, this is fascinating, of course. It's fascinating in a number of ways. It's fascinating because the topics are fascinating. When we talk about the future, it's always just very engaging, a lot of fun, very interesting, very complex as well. It's fascinating because of its implications on investing, and it's fascinating when you take the angle that that StashAway has in terms of helping people build long-term wealth, because these are in a way long-term themes, meaning that I guess it's very difficult to predict what's going to happen in the next 6 to 9, 12 months in some of these topics, but actually it's more of a directional bet on the fact that 10 years from now there's going to be more electric vehicles than diesel vehicles. That's, I guess, the way you can think about some of these topics. I think it's very interesting because it has this long-term component, which again, when each of us think about how do I want to retire and how do I think about preparing for that financially, it triggers some questions. But let me make a few steps back. So now we know what we're talking about. We're talking about investing in themes, investing in the future, if you want to angle it. Now, why should anyone invest part of his or her portfolio in thematics? Maybe Freddie, why don't you start? So why can thematic exposure help in a portfolio?
Well, thematic investing essentially is about identifying those big game-changing trends and phenomena that's going to impact societies and our environment, right? So they're going to affect how we live and work and operate our daily lives. And what better way than to benefit from those seismic changes in the next 5, 10, 20, 30 years in our lifetime than being in thematic investing. So it is something that I feel complements rather than competes with your existing financial plans or your existing diversified portfolio. You may feel strongly about a certain trend, your personal beliefs and value systems and research reflected that, and you wanted a bit more exposure into a certain disruptive directions, innovation directions, or healthcare directions. I felt they complement and they give the user that choice to just fine tune their allocations. So I don't think they compete, they complement.
Thank you, Freddie. And Ren, so when we spoke last week, as we were preparing for tonight, you said something that kind of stayed with me. You said, thinking about innovation as a hedge. Can you elaborate on how you thought about it, how you think about it?
Yes. So I do a lot of presentations around how big these technologies are going to be and how excited we are about investing in them. But we don't do as much. We should have a discussion around what the impact of these technologies will be to the traditional existing industries, right? So as a result of these innovation platforms, impacting our lives and impacting the markets, it will come with, the potential for disruption of entire or partial industries, right? So, and a lot of investors have exposure to those industries. So just a few come to mind, and some of which are kind of some of the best performing this year is energy and financials, right? And if you look deep down into those two areas, right, you'll see energy, primarily fossil fuel based companies, right? And those are probably becoming the most vulnerable to disruption. As I mentioned, we're shifting away from gas powered to EVs. Now, transportation makes up roughly, I think, in the 40 to 50% of oil consumption, but we think oil has peaked, right, in terms of demand, right? Maybe not the price, and it will be much more volatile here. We've done a study going back to whale oil to look at the volatility as we were making the transition to oil. Whale oil went crazy in the short term, but obviously not part of our lives anymore, right? So that is something to consider, right? And so and then maybe I'll give you an example on financials, right? The big banks, these now, because of digital wallets, that's really upending kind of the traditional banking structure, right? You can do everything from your phone. And we've seen this happen in China. They've been the leader with Tencent and Alibaba. And now we're seeing that in the US. We see it throughout Southeast Asia. I mean, all of these countries will have a designated winner or two digital wallet platform that people will use. And they'll be able to not only handle all of their, StashAway is one of them, right? A digital app that is providing that access, right? But they'll be able to do so many more things. As we've seen in China, that screen space is related to financial assets is only 50%. The other 50 is around maybe food delivery or ride hailing. So this is a kind of tapping into a bigger market. And so, yes, there will be some banks that exist. You'll still need some aspects of that, but a lot of the traditional banking that we all do on a day-to-day can be all done via digital wallets. And so, this can have a negative impact on traditional finance. And again, that's, I think, the third largest sector. If you look at the S&P 500, a lot of people, I think there's over 12 or 13 trillion dollars linked to that S&P 500 index, right? Investor capital. If we think, and we estimate roughly 50% of those industries and companies are at risk to disruption because of these 5 innovation platforms, that's a concern over the next 5 to 10 years. And so I mentioned hedge, because if we're right about, the potential, the growth potential, and we're right about the potential destruction of capital or disintermediation of some of these industries, you want to have something to protect you against that, right? And I think having an allocation to innovation will help protect you against that. You'll have exposure to forward looking, and you'll also have a hedge against the potential disruption. And so we put out our big ideas every year, right? Of kind of, their top ideas for the coming year and kind of breakthroughs in our research for that year. But we also put out last summer a bad ideas report, right? Where we highlighted 5 industries that we thought were becoming more vulnerable to disruption. And so I think investors have to think about that as well, because they probably have exposure, whether they realize it or not, they probably have a lot of exposure to that as well.
Thank you. So, the idea is, look, you do traditional investments and some of the companies you're investing in might be at risk. So a hedge is to actually make sure you have some exposure to the players that are putting the traditional ones at risk, so that, if one of them will succeed and save your portfolio. I understand that. So you mentioned big ideas a second ago, and so you release every year the big ideas report, and I encourage everyone, just for fun at least, to kind of have a look at it. It's fascinating, again, thinking about the future. And in 2021 big ideas report, you have 15 themes, which clubbed into the 5 platforms you mentioned earlier, and they go from deep learning to Bitcoin, from electrical vehicles to 3D printing, and to multi-cancer screening. Now, I'm guessing that you actually could list more than 15 themes. You could probably list 20, 30, 50, 100, I don't know how many. How do you pick the 15 themes to focus on, and how do you build conviction around them?
Yeah, so that 15 is a dynamic number, right? So I think in 2020 we had 12 or 13, but what we're looking for in that report, or what we're trying to share there, is breakthroughs in our research. So I think what really differentiates kind of our style of investing is we spend a lot of time on the top-down technology sizing of these opportunities, right? That helps us, that guides us to where we want to invest in, right? Many investors, and we thought even venture capitalists were doing this type of work, and really they're not. They've come to us and said, where have you gotten this data? And we said, well, we've been, it's all our own research, right? But if you have something to weigh in, let's join forces and let's talk about it. But what we've done is look at these individual technologies, and that stems from the analysts having that domain expertise in these technologies. So they all stem from those 5 innovation platforms. And what we're looking at, we've identified 14 kind of transformational technologies, underlying technologies built on those 5 platforms, right? And from there, you have roughly maybe 25 themes or technology elements, we would call them, right? And so as we're doing our work around kind of from a top-down perspective around how we size these opportunities, what we look at is, well, what's the cost decline associated with these technologies, right? Is it hitting a tipping point, which is going to unleash a tremendous amount of demand for these technologies? And so that's the way, when we look at that, we can forecast the future cost decline, which helps us understand, well, what's the future demand, right, at certain price points over time. And that's how we build these adoption curve rates. And from those adoption curve rates over the next 5-10 years, we can build, well, what's the total addressable market for this technology, right? EVs is a good example, right? Electric vehicles. We think that consensus right now, there's estimating that in 2025, 6 to 8 million EVs will be sold. Our forecast, based on that cost decline, we think will be closer to 40 million EVs being sold, right? So, more than 5 times higher than what people are expecting. Is because they're not focused on the underlying cost of that technology, lithium-ion battery, and how it's declining so rapidly to a point that we think within the next year and a half, that EVs will actually be priced below gas-powered cars. And that's when, as a consumer, already the cost of ownership is much lower, right, for an EV, but most people don't do that complicated math when they're looking to buy a car. It's when they walk into the dealership and they see, hey, this EV is actually cheaper than the Toyota Camry I prefer to buy. Now it makes sense to make that shift. And that shift is starting to happen, and it will accelerate even more, right? So when we come up with these total addressable market for each of these technologies, and it's much bigger than what Wall Street and the market is anticipating, that's when it becomes very interesting to us, right? And there's an inefficiency out there in the market where it's likely that these stocks and companies that are enabling these technologies are mispriced, right? And so there's an opportunity for us to buy those potential winners, right, and build a portfolio around that. And so as that kind of transitions into the Big Ideas report, we're highlighting each of those kind of technologies, really, that we think people are underestimating, right? And it's a culmination of the work that we've done over the last year. So right now, we're starting to work on Big Ideas 2022. One of the things that we've revamped in terms of research is artificial intelligence, right? In that Big Ideas report just last year, we sized that opportunity at 30 trillion. Now, as we're going back and doing the work, we think that artificial intelligence could be almost $100 trillion opportunity over the next 10 years, right? So it's tripled because of some of the technologies and how they've accelerated in adoption. So our research is constantly evolving. It's very iterative. We're constantly getting feedback from these communities that are driving some of these technologies forward. And a lot of that research is going into kind of this Big Ideas report.
Do you have a favorite theme out of the 15 that you published last year, or maybe the ones that you're going to publish next year, or you have a favorite one?
Yeah, that's a tough question. You're making me choose amongst children here. So one that we talk about a lot is in the genomic space, right? As it relates to kind of how we've been dealing with the pandemic, right? And specifically, one of the technologies is long read sequencing, right? So this is a kind of a newer method of sequencing your genome, which is allowing us to get more accurate information. And I think this we believe that this will spawn more technologies that are being built on top of that, which is around identifying diseases, right, early on. So think cancer. And this is feeding into kind of multi-cancer screening, right? So we will be screened, we'll likely get our genome sequenced, once a year or every 2 years and track those mutations over time. And if we notice something that's out of line, we actually have, technology in CRISPR gene editing, which allows us to edit a mutation, right? And potentially cure that disease that's developing. And, this is, we're years off, but it's starting. I mean, this research is happening, right? In terms of CRISPR gene editing, we've been able to, there's a company we own that has cured patients with sickle cell disease, right? By editing their genome or editing a specific gene that has caused that disease. And so this is huge. This is exciting. This is talking about extending life, but also detecting diseases that are, killing many across the world, unfortunately, like cancer. This is a solution. So it's not maybe about curing cancer, it's detecting it early and being able to treat it most efficiently. And that we think can extend life and save many, tens of thousands of lives, at least here in the US and beyond, if you extrapolate that, hundreds of thousands of lives globally.
Thank you. So Freddie, turning to you. So Ren talked about 25 technological platforms, 15 big ideas, 5 major platforms. StashAway, you kind of led obviously the thinking behind how to structure exposure to thematics, and you end up grouping these themes, these investment in 3 logics. One, tech enablers, as I mentioned earlier, future of consumer tech, and healthcare innovation. So if I'm an investor, how do I choose where to invest? Which one of the 3? Does it make sense to invest across teams, or do I pick one? How do you think about it?
It's a tough one because I like them all. I think that you have to start with your personal beliefs and your personal research. Is there any team or phenomena, big trends that you personally relate to? If you don't know enough, but you fear the disruption that could impact your portfolio in the future, then I like Ren's approach where you sort of spread across as many innovation and disruptive investments related area as much as possible. I think StashAway made it very easy to do that, because what's happening in the fund management industry is a blanket sort of disregard of a user's personal risk tolerances versus the team. A team sometimes could be relatively more volatile than a person's risk tolerances. And so the person might be put off investing in it. That's a shame. I think anybody should get an equal chance to access all these very interesting opportunities. So what we do that's unique in the industry is that we are sort of mixing first of all, we created a lot of sub-teams to diversify risk. And 2, we augment the thematic basket of exposure with a basket of protective assets that in the whole grand scheme of things, they mix together to give you a particular risk profile. So you can have a range of StashAway risk indices that you're used to on the platform. You can still do that and still invest in a team that generally is higher volatility than average. You can still do that on our platform. So I think that is the democratic approach, the risk-based approach that I personally I'm in love with. So if you ask me to choose a team, I'm actually not going to answer that question because it's like choosing among the babies, right? So I personally do relate to genomics, immunology, and biotech a lot because of the pandemic, perhaps. But I feel that disruption can take place in so many different dimensions of our future society. So it's best to spread your bets as well when it comes to thematic investments.
Okay, so I guess I'm on the same page. When I asked myself, to pick babies, quoting both of you, I decided to actually. So actually, what I did is I'm dollar cost averaging inside each of the three teams. I picked one risk level for each of them, and I'm dollar cost averaging in each of the three. I kind of that's the way I'm approaching. So I guess I also decided not to choose among babies, like you said. Ren, back to you. So once you decided on a specific theme, I guess the next step is to say, okay, we believe in a theme. We now need to know who are going to be the winners inside these teams. Because at the end of the game, your goal is to make money out of this, right? So you want the winners, you want the people that will build the biggest companies, the most successful ones. So how do you pick them? How do you pick the winners?
Yes, no, that's a great question, right? And so we use our kind of bottom up process to do that, right? We've identified the theme. We think there's a mispricing out there for that technology, right? It's undervalued, and then we go out and we kind of use that as our screen, right? So we don't start, we're not using an index or anything to screen for ideas. It's really our research that kind of filters in, and we look at, well, hey, let's just take CRISPR gene editing, right? For an example, it's a small universe of stocks that there's 3 stocks that have the foundational patents for that technology, right? And so, our universe has been narrowed down to those 3 companies, and we look at each of those companies. And so across all of our holdings, we look at kind of 4 main qualitative factors, right? We look at, well, what's their management, their team, and kind of culture, right? We're looking for these companies to have that DNA, their innovative DNA, and built from the ground up to be kind of this, potential innovator and disruptor, right? We're looking at, well, what's their product and service leadership? Are they gaining traction, market share? Are they taking from incumbents, right? And we can see that over time. We listen to their earnings reports and we see and measure how they're starting to gain traction. So like a Tesla taking share from traditional auto manufacturers in terms of the number of EVs that they're selling. So we can track that. And we look at it from a technology and cost perspective, right? So we're comparing that. We're looking at their barriers to entry, right? Or their competitive advantage. And much of that could be around the technology. Our analysts can understand the technology advantages there, right? Back to Tesla as an example. Their batteries cost, much less than traditional auto manufacturers. If you compare it to Audi, for instance, Audi even did a tear down. It was $4,000 or $5,000 cheaper per vehicle on the battery pack management system. That's the most expensive component, right? So for Audi to break even on their EV business, they would have to sell, I think they estimated at 600,000, right? Tesla is being able to pass that along to consumers by delivering an EV that's 35,000 here in the US, right? And plans to make that down to 25. So they have that barrier to entry to get in, right, at a lower cost. And then kind of the last one is kind of their ability to execute. And again, that's something we look at on a quarterly basis, right? Are they able to deliver on kind of their longer term vision? So if we like all of those and we score each of those, and if it hits a certain score or higher, it becomes kind of eligible. But the big kind of important factor is around valuation, right? So when we look at a company, we construct a price target, a 5-year price target based on a lot of the top-down expectations, but also because of their advantages, what they will be able to gain in terms of market share, right? So we'll have a 5-year price target. We look at that current stock price of that company today, and if we can achieve a 15% annualized return over that 5-year period based on our 5-year expected price target, then it meets our hurdle rate of investment, right? So if it's below that, we typically will continue to follow it, but not make it part of the portfolio. And then the last piece of that, we also, there's always a risk, right? And so we assess kind of the thematic risk or really thesis risk to each of these companies. And so we'll factor in any geopolitical risk, things that are happening in China now could potentially impact some of those names. What we're seeing in around regulatory risk, when we're talking about autonomous driving, that could potentially slow down the adoption. So we want to factor in that, do stress testing. And so that could impact kind of the overall score of the company. And so, typically the higher the score that we assess based on those qualitative and valuation factors, the higher the weighting in the portfolio. And that's how they kind of make their way into the portfolio. And they're very dynamic. We're very active in our trading, right? So if we find something, if there's newer technology or a new competitor that is gaining traction that we like more, we're very quick to make that decision, and it's reflected in the portfolio. We're very, not very much kind of buy and hold investors. We're long-term investors, but we're short-term contrarian, and we could kind of take advantage of some of the volatility in the short term to reposition the portfolio, over time.
Understand. Thank you, Ren. And so on this point, so Freddie, obviously, as StashAway for the last 5 years, we've been talking about why we want to be passive on security selection, and we actually have an active strategy at the asset allocation level, but not at the security selection level. Obviously, with Thematics, we have included ETFs like the ones managed by ARK that are actually actively managed. So why have actively managed funds in a thematic portfolio versus not in our traditional ones?
Well, thank you, Michele. As you have absolutely pointed out, we are neither active nor passive. We tend to not like to be active in security selection, but in terms of asset allocation, we, like ARK, we do get this feedback loop in terms of the latest information that comes in from the economy on growth, on inflation, on interest rate outlook, the macroeconomic trends. But also at the same time, there's this feedback loop from the market about valuations. So we actually think the philosophy is very similar to ARK in the sense that while ARK is very focused on futuristic opportunities, exponential growth, game changers for society, that's what we like. ARK also has this feedback loop that they're constantly reevaluating if valuation is off versus their scenarios, the scientific scenarios rather than the market scenarios. They would make this call that it's not a good time to be in this name now. We fight another day. We have another opportunity. So I'm probably just phrasing what Ren has said earlier in another way. But that philosophy is actually very similar to what StashAway's ERAA framework is doing. ERA is economic regime-based asset allocation, and it's based on economic factors. It's actually not very active. It's sort of strategic. It's sort of medium, long-term adjustments, and it looks at valuation also from a couple of years of time frame. It's not like a couple of months. So even though we are not passive here, it's actually quite similar in spirit. We're looking at the big trends in the economy. In our case, ARK looks at the big trends, big valuation gaps in futuristic companies versus their scenario. So we like that. As long as that's the case, we love what ARK is doing. As long as it's not a sort of a actively, the active strategies, it depends on how you define it. We felt ARK is an actively curated strategy based on the team, rather than the active market factor strategy. So I don't know if I make it clear, but so that's at least from the outside, that's in our due diligence, this is what we see and what we liked.
Thank you, Freddie. And maybe I'll stay with you for a second. And so you decided, or the StashAway decided to launch balanced theme portfolio, meaning that clients can decide how much risk to take on each theme. And obviously, in order to reduce the risk in a portfolio, there might be some thematic exposure and some balance in assets, bonds, for instance. Now, why did you decide to do it this way?
Well, it's really to sort of be consistent with our risk-first approach. Michele, Nino, myself, we founded the company based on the risk-focused approach first, then you maximize expected return. It's the same thing. For us, as I mentioned before, we felt that one should not be put off by the relatively higher volatility in thematics, especially when it's something so innovative, disruptive, so futuristic. There's a lot of uncertainty in the meantime while getting to the exponential growth. And it's by design inherently more volatile than traditional assets. So to help our user get more comfortable and not be cut out by this opportunity simply because of the volatility, we tailor it so that they get their own risk profile as in other products we have on the platform. So it's really to help user get comfortable with having thematic exposure. But of course, user can actually do another way. It could have just simply said, I can allocate less money. I just want 100% exposure to the team. So they can still have that choice and select the highest risk profile on a particular team on the platform, and they just dedicated less funds to it. That's one way to do it. But we are giving user every possible choices in this case. Hopefully that answered the question.
Yeah, thank you, Freddie. So I'll ask you a question to both of you. So a lot of people think that today the markets are priced very high. And then in particular, technology has priced in a lot of future growth, because of the rally of the last year and a half. So maybe Ren, starting with you. So is this the right time to invest in technology? And you kind of implicitly answered by talking about $100 trillion, but I'll ask you the question anyway. Is this the right time to invest in technology? And what do you think about the pundits that say, hey, it's already priced in, it's too expensive, wait?
Yeah, no, I mean, that's something that comes up very often. I mean, if you compare it to the valuations at the beginning of this year, right? So in January and the first half of February, before kind of this whole rotation away from growth to value-oriented stocks, you look at our expected, and we calculate this across our portfolios. I mean, this is more kind of internal that we use, but we look at, well, what's the weighted average expected return on each portfolio based on our 5-year price targets of each of the underlying companies, right? And so I mentioned earlier, 15% is our hurdle rate. So that's really our benchmark. We want to exceed that over a 5-year period. And so when you look at our flagship portfolio, the ARK Innovation ETF, that incorporates all of the technologies, right? That was around 16%. So it was above 15, but on the lower end of where we typically have seen historically. Now you go back a year, it was closer to 40% annualized over the 5-year period. Fast forward today, where we're seeing kind of this sell-off in innovation and technology into value, it's now sitting in the low to mid 30s across our portfolios. So when I look at it from a valuation attractive standpoint, it's gotten 50% cheaper, right? And so we think it's a very attractive opportunity to get in, right? And if we're right, obviously, if we're right about this, that could be potentially more than almost a quadrupling over the next 4 years, right? Based on our expectations of these market caps. And I think, again, back to, I mentioned earlier, the pandemic accelerating these technologies, that has strengthened the case around this. But again, you have to have, I think what's important here is we don't have a short-term view. This is not about making a quick dollar in the next 2 months. This is long-term thinking, right? You're allocating, this is over a full market cycle, which can take at least 5 years. But from where we see the valuations today, in innovation specifically, it's very attractive from our perspective.
Thank you, Ren. And Freddie, from your perspective, so how do you think about it? And what are the strategies that people can use to potentially kind of reduce further the risk of entering at the wrong point?
Well, first, if I take a step back and if I look at any financial markets charts, historical charts, they always, if you just ignore the last 10 years, you were at the highest point. And now you look at it, it's at a new highest point. So it's part of human nature that GDP grows, we innovate. And so you can't use a price chart to say the market is too high, I'm going to wait, because you could just keep waiting on the sideline forever. And I've seen it happen in 08, 09 to a lot of people, all right? And so I felt that historical data is history, it's in the past. And thematic investing here and some of the ARK funds, they are philosophies and they are central framework is about the future. And the future is still being crafted. It needs to be iterated. New information comes in. You update your model parameter, update your valuation, update your return upside, your expectations and everything. It's an iterative process that ARK is bringing to the table. And for StashAway perspective, we sort of look at it at the same way as well. We knew that you cannot use the past to predict the future, and you rather look at the factors, the big trends that's influencing the world from here, and you make an educated investment decision, right? So being high in valuation today may actually be an undervaluation to a future that's less than understood by Wall Street, as Ren has mentioned. And I actually believe in that. There's a lot of market inefficiencies, especially when it comes to innovations. And so I share the same stance with Ren in the sense that there's never a better time. There's never good or bad times. If you are worried about it, what you can do is to smooth out the noise the market volatility brings to your net worth by dollar cost averaging into a team, much the same way as you are investing on StashAway's platform for the last 4 years. It's the same thing. If you're worried about it, you split your savings, right? And most of us are savers. We have monthly income, expenses. We try to save and we try to deploy those savings systematically over a long period of time. I still feel that's the best way to answer this question. If I don't know, that's what I would do.
Understand. So I think some of the themes that we talk about very often, have a long-term view, ID may perhaps dollar cost average into the market. So, with the same long-term view, you don't risk of kind of getting in at the wrong time. And then, as Ren mentioned, according to their models, actually, valuations are right now in a good place. One last question from me before I go through some of the questions that we received. We actually already answered some of the questions from the audience, but I'll pick a couple more. But before I go there, one final question from me, which is, we talked about long-term. So let's fast forward to 2040. You're now both retired. Yeah. And what's the theme that helped you the most build your retirement nest egg, Renato?
All right. Well, I'll start with what will get me to live that long will probably be genomics, right? So I'm banking on all of that, right? Succeeding. But yes, once I get there, I would say it probably going to be when we size each of these technologies, the mega opportunity, there's two. One is artificial intelligence. I mentioned $100 trillion plus, and we're revising. So we're going to be releasing some of that research soon. And that's also, as I mentioned, kind of impacting all the other technologies. And so there's S-curve effects, right? And so that leads to even more exponential growth. And so some of these even underlying technologies will benefit from artificial intelligence. So if you had to pick one, that's probably going to be the most value creation, right? And I think close behind that is probably going to be blockchain technology. We're seeing that as a mega opportunity, still in the earlier kind of stage, right? But still an investable and one of the platforms that we think could be multi-trillion-dollar opportunity, and very, when you look at the market cap today, very small of what it could potentially be in the next, well, certainly by 2040. We don't go out that far, but by 2030, yes, could be a sizable.
Thanks. What about you, Freddie? What will make you retire well?
Again, it's like choosing among the babies. Because we curated these 3 teams. I like them all. I love them all because they impact our daily lives. They will continue to do more and more of that from here. Tech enablers, obviously, all the robotics, AI, even blockchain has been mentioned here by Ren, is included in that one portfolio. I'm particularly fascinated by that mix. But also I want to live long and healthy when I retire. So, and genomics is one very fresh way of fighting cancerous disease, not just being in vaccination, but it's also in cancer fighting, right? So I personally would invest in healthcare a lot, healthcare innovations, not traditional healthcare. But other than that, disruptive tech like AI, robotics, blockchain, I'm particularly fascinated.
Good. Look, I'll pick a couple of questions that we received from the audience. One is, you both mentioned blockchain, I think Bitcoin earlier, Ren. So there is an anonymous attendee asking, Bitcoin is such a volatile commodity. How will StashAway be able to quantify the risk index for clients like us to consider when we determine our portfolio risk? I want to split this question into 2. One is, Ren, you mentioned earlier Bitcoin. How do you get exposure to Bitcoin in your portfolios? And maybe then, Freddie, I'll ask you, how in this context, how do you think about it within a StashAway portfolio?
Yeah, so in our view, the best way to gain exposure to Bitcoin is a direct investment, right? And currently, right now, this is changing. We're in the middle of potential Bitcoin ETF approval. So the regulatory environment is changing. But currently, GBTC, which is the Grayscale Bitcoin Investment Trust, provided the only kind of direct exposure that we could include, and we have an exemption with the SEC here in the US to have an allocation to that. That's only in the ARKW ETF, so the next generation internet. But that's how we gain exposure, direct exposure to Bitcoin. Now, as that technology is developing, we're seeing more opportunities. So the universe is growing, which is good news. So we'll likely see over time more exposure where we can get more direct. It may not be direct crypto investments, but more companies with more direct exposure to blockchain, like Coinbase, for instance, which is a top holding in 2 of our ETFs. That provides kind of the on-ramp to crypto assets and for both individual investors and institutional now. So that provides kind of more direct exposure to blockchain. And there's a few others that have kind of indirect. Square is also providing kind of through their digital wallet the ability to buy and sell Bitcoin. So we have some indirect exposure there and a few others. So that's how we can do it currently. But that universe, I think, is going to evolve and increase over time.
Well, I'm going to go top down first. The motivation for including alternatives, such as a cryptocurrency exposure, will really be in the form of diversification, because the impact they brought and they pass a threshold where there's critical mass now, and it's too difficult to ignore. However, who knows what the future holds, because this is a big disruption battle going on right here. And in the name of the, in case you miss out on something, it could be a hedge for disruption. It could be a potential return booster. You simply do not know. So you need to take a diversified approach, and hence having some exposure is always probably a necessity from that perspective. Now, but then more specific to Bitcoin or any other cryptocurrencies, I think Rand mentioned at the S curve, so that this various phases of adoption and the economies of scale over time changes. So as you gain more mass, the network effect, for some of you who wants to know more, check out McKelvey law. The network effect is how to value utility-based token. They bring a certain very, very unique framework of valuation compared to traditional metrics. But what it's saying is that adoption is key, and it can go in the S shape or multiple S. Who knows what's going to happen? And so if we model this, the StashAway perspective is forget about return. Focus on the massive historical drawdown in the past. And you ask yourself, X% allocation, in the worst case, what would that be? And is that controlled? Is that something that can be tolerated by the user? So if I bring it down to the level, it can still be modeled if you just focus on the market risk of this thing. And from that angle, so diversification and risk budgeting remains the same principle that applies to such assets as well. I call them exponential assets or forward-looking assets, not traditional assets, but they do present a certain opportunity to investors over time.
Thank you, Freddie. So there is one topic that's brought by an anonymous attendee, which I don't think we talked about. So when we did a StashAway reoptimization back in July, the reoptimization was done because we said the inflation is growing, and we want to prepare the portfolios for growing inflation. And people reading financial newspapers would have probably noticed that the word inflation is coming up more and more over the last few weeks, with further confirmation that this is happening. So there is a question from an anonymous attendee asking, what is the view of the impact of inflation on thematic portfolio? Are these portfolios more protected than traditional ones with respect to inflation? And what about the volatility of the underlying assets? Not sure what that means. Maybe Freddie, you want to take this?
Yeah, the short answer is absolutely. In our quest for curating all these teams, we also, through the data analysis, found that there's a lot, when you break down an exposure of an asset class, we tend to find that disruptive innovations, healthcare innovations, and the teams that we have curated so far, they're actually great inflation beneficiary. They do outperform inflation if you have inflation. And another way to think about it is that maybe some companies get hurt by inflation because they're antiquated. So investing in traditional assets, you have a risk of being eroded by inflation. However, a lot of these new technologies, new investments, they avoided the same problem. They are more efficient, more productive, and they are more future-proof. And so having a mixture of some of these teams that we curated actually brought a lot to the table in terms of not just hedging against disruption to the world, but also against inflation. I actually do see that inflation hedged inherent in all three of the teams that we have curated today.
Thank you. So I think we went through most of the questions, and I think we're past the hour, and I want to be respectful of everyone's time, both Ren, Freddie, as well as the many participants here. So I just want to thank you guys for the very interesting conversation. I am even more thrilled to kind of look at the future. And to be honest, as I was reading the big themes presentation from ARK in the last few days to kind of prepare some questions, I find it, it's super exciting to think about the long-term future. So again, I invite everyone not only to think about how investing in innovation and technology can help your portfolio, can hedge your exposure to traditional assets, and can potentially give you outsized returns over a full cycle. As Ren mentioned, long-term thinking is very key in this topic. But on top of thinking about it, I think there is a second angle, which is it's just a very interesting topic to explore and understand that there is a lot of material out there. As Ren mentioned, ARK actually publishes a lot of research on this topic. So if you don't know what to do this weekend, I think that makes it for some fun and interesting reads and conversations. So enough said. I just wanted to thank you so much, Ren. And again, I know it's early in the morning, New York. I hope it was a good start of the day for you. And obviously, thank you, Freddie, as usual, for your contribution. And thanks everyone that participated.
Thank you. Take care.
Thanks a lot. Bye-bye.